Thank you for sticking around for this panel. My name is David Kaufman. I'm the president of WESTCOURT Capital. We specialize in sourcing and due diligence of alternatives across the board, especially in the real estate space. And we have a very large mandate here today. We have also 4 panelists, so we're going to try and dive right into this and talk about, in a general aspect, where alternatives fit into portfolios. That's an enormous question. We could spend a week on it and barely scratch the surface, but we're going to spend 25, 35 minutes and see how deep we can get. Before I ask the panelists to introduce themselves, I just want to sort of get definitional for a second. What do we mean by alternatives? If we assume that most people enter a space with a 60-40 split between equities and fixed income, I suppose that you could define alternatives by what they're not. They're not publicly traded equities, generally. They're not publicly traded debt, which leaves everything else, which is a big world. So you have real estate, managed futures, private equity, hedge funds, which are not an asset class by any means, but certainly are alternative, and different types of structured product that cross the gamut across the globe. And we are faced with in the 60-40 world, of course, with the issue of high volatility and volatility fatigue with equities, which of course are accompanied with relatively low returns, which is a double whammy. And speaking of double whammies, we have the ultimate double whammy in the fixed income long bond world of negative real returns and the assuredness of having negative returns, period, as interest rates eventually rise, which they're defying gravity now, of course, but how long that can last is anyone's guess. So we'll have an interesting conversation today about how people might diversify out of the 60 or the 40, and I'll ask each of the panelists. We have a wonderful crew here to explain where they're from, what their point of view is, and then we'll jump into some questions. And go ahead, Ron.
My name is Ron Mock. It's a pleasure to be here this afternoon. I'm with Ontario Teachers Pension Plan, and I'm lucky enough to work with some pretty interesting partners up at Young and Finch. I look after the world of fixed income and alternative investments. Alternative investments means hedge funds. It means emerging markets debt. It has a number of subcomponents to it, all the way through to intellectual property and royalty stream investing. I'm also a member of the investment committee at Ontario Teachers.
My name is Ryan Barry. I'm with Diversified Global Asset Management. We build portfolios of hedge funds and hedge fund risk premia for pension plans all over the world. Our clients are in the U.S., Canada, Europe, Middle East. We run the gamut, I would say, in terms of the kinds of strategies we look at. Everything from traditional equity-centric risk to structured credit to credit relative value to managed futures to commodities to reinsurance in our business, and we manage and advise on about $5.5 billion of assets.
Hi, my name is Peter Klein. I'm a retired derivatives trader and investment banker. A number of years ago, I left that to become a finance professor at Simon Fraser University. I teach courses in portfolio management and asset allocation. A lot of my research is in derivatives, trading strategies, hedge funds, hence my involvement with KCS Fund Strategies, Inc. that I'm representing today. KCS offers hedge fund due diligence and portfolio management services for high net worth and institutional investors and their advisors.
My name is Craig Machel. I work with MACQUARIE Private Wealth here in Toronto, and I provide advice to the private client retail side of the business. Most of my clients we work together in terms of building and ensuring they've got a retirement pool out towards the future. Most of my clients don't have the luxury of having a pension plan. So we work together in terms of building that, and a large part of the advice I provide and sort of the edge that I provide rather than the 60-40 sort of split that David referred to, is to provide that education and then implement and act on strategies which include a great deal of alternative investments.
Terrific, thanks. So the last 30 years generally have been not unkind to 60-40, which is interesting. It's got a compounded return of somewhere near 10% if you have the right kind of balance. Of course, that looking forward, we know that the past is not the future for the reasons that we just alluded to. So the question that I would have now for everybody is, after the last 5 years of extreme volatility and disappointing results, how can the inclusion of alternatives generally into a portfolio help right now? And if you want to then go on and say where you'd point first, please feel free. Start with you, Ron.
Last 5 years, 2008, we'll set that aside for a second. The last 5 years have really, in my mind, shown how important it is to have alternative investments in a portfolio. We manage the retirement income for 300,000 teachers in the province of Ontario, and we have one single focus. They're our clients, and our job is to make sure that we can pay their pensions when they retire. And it's just that simple, and every day we come in to do that. And in order to do that, we have to be very clear what it is we're trying to achieve. What we're trying to achieve is upper quartile results on a consistent basis to the best of our ability. And if there's one free lunch left, it's diversification. And from our perspective, you have to have a very clear idea of why you're going after certain asset classes, where they fit into the portfolio. Alternatives for us are really, really an important part of portfolio construction. And by that I mean, broadly speaking, infrastructure, real estate in the form of Cadillac Fairview, a good smattering. We have about $6 billion invested in hedge funds. And you know, having alternatives really delivers very specific things. And I'm going to give you a simple case in point. We own real estate. It's in the form of Cadillac Fairview, but not all real estate is created equal. If you own a real estate company and they have hundreds and hundreds of hotels in it, you've basically got real estate with one-day leases on them. And so when the economy gets into a problem, you'll see it. On the other hand, if you own office or other types of real estate where you get 10-year leases, you can ride through business cycles very, very much easier. And so every asset class, every alternative asset class that we add, it's very important that we understand why we're adding it and where it fits into our liability structure and our return structure. And I won't go on about it. This is a long and a huge subject. But alternatives in our world are a critical component to achieving superior results over the long haul to meet the mandate for the teachers of Ontario.
And Ryan, before you can start allocating to hedge, first, of course, you have to get an allocation to alternatives. So how do you describe it to your institutional prospective clients?
The institutions we work with are trying to find something that, in our experience, is truly diversifying risk premia. They don't need hedge fund risks which have a 0.8 or 0.9 beta to equity risk they already have. If they want to do that themselves and take that kind of risk, that's fine if you want to do that as a component of active risk in an equity bucket. But if you want something that's truly diversifying, that does not load heavily and actually provides the kind of diversification that Ron is referring to, that's essential. So we tend to spend a lot of time focusing on strategies and risk premia that really do not load heavily to market risk. And we tend to have a preference to work with people who focus on taking idiosyncratic risk where they've actually got some expertise and don't take a lot of residual beta risks that we don't want and that our clients don't want. I think, and when you do that, I think you can deliver better risk-adjusted returns and higher Sharpe ratio returns that are actually accretive, rather than just representing high beta loading to equities that's very expensive.
So, Peter, as you engage in the same kind of deep dive due diligence into hedge, does it matter who the end user is? Do you whether it's high net worth or whether it's institutional?
Sure. You really want to look at their objectives overall, what their risk budget is, for example. Many high net worth investors want to be able to talk about the latest and greatest hedge fund on the cocktail circuit. We try to dissuade them from that. We think there's a better risk-return trade-off in the low end of the risk spectrum for hedge funds. Institutionally, you see less of that.
Okay, now, Craig, you, of course, deal with individuals on a daily basis and some endowment foundation work as well. So what's your experience been coming from not exactly the bank world, but almost the bank world in terms of educating the end user about the inclusion of alts?
Right. Yeah, it has been a great education, due in large part, I guess, to the financial crisis. Clearly, is that individuals and institutions, I think many of us around us, have raised their hands and said, what else is out there? People have been disappointed in the last 5 years, the last 10 years in terms of equity returns, and, well and truly, there's a lot of emotional sort of push and pull, which have been self-defeating on the retail side, amongst people themselves. So the answer is it's been a positive progression in terms of what else is out there. And just as the world has innovated around us, so has the investment world, and that's where my clients are coming from, is simply saying, look, I didn't sign up for 8% a year with 50% drawdowns. I simply want 6 to 8% return in terms of consistency, and I want to know within my short little time frame that I'm going to have that capital I need, at which point it'll be a liability-driven issue, and I can start drawing out of it.
Okay, so this idea of diversification, which is not new, it comes, every one of you talked about it. And of course, if you want to achieve real diversification, there has to be a relatively low correlation between the strategy that you're considering and the ones that you already are deployed to. And in Canada, if you were to go to the corner of King and Bay right now and say, what's the very first word, we could even do it in this room, the very first word that pops in your head when you hear the phrase hedge fund. What's the first word? Risk. It's the first word. And now, whether people in the industry understand that that's incorrect or not, that's kind of irrelevant. It's because that's what kind of irrespective of who you're asking, that's what comes up. So the question is that well-deserved in Canada, where we've had a lot of, unfortunately, sort of levered long so-called hedge funds that weren't hedged at all? Is it unfair? Is it ignorance? What is it that leads to that, and how can we combat that to help people gain true diversification moving forward? And I'd like to actually start with you, Craig, because you deal with the end user on a daily basis. Right.
That's certainly been an issue over the years. I think that's lessened as the years have gone on. I mean, we all contended with Madoff back in 2008, and that's, fortunately for Canada, we've been exempt of much of that. But like everything, these things take a long time to catch on, and for the misgivings and the misinformation to be sorted through, whereby the proper education and the proper, the reality of the hedge fund world is put forth. So it's a matter of a lot of education, and clients really have to be, my clients anyways, really have to be, sort of thinking really very much differently about this and be open to a new form of investing. And then it comes back to the advisors and the allocators and everything else who, rather than just simply looking out at returns and saying that's a great 3 or 5 year track record, we'll go with that. We can spend a lot of time talking about this, but there's got to be an understanding as to how that return came about. And we saw Nassim Taleb last night here in town. It was a good presentation. He raised a good point. How fragile are your investments in the context of immeasurable risks out there? And that fragility notion speaks to David's point in terms of, is it a levered long warrant bet at the one extreme, or is it a conservative market neutral hedge fund at the other extreme? And that's where the advice comes from, or starts, I suppose.
Right. So Peter and Ryan, you both spend your days doing, I guess, both qualitative and quantitative due diligence, but I guess it would always start with quantitative to see whether it's something you'd like to look further into. So how much focus is there on identifying strategies that have a long history of doing something different and providing either somewhat negative or certainly low correlation?
You certainly want to look to the long-term evidence. And the long-term evidence is very clear that the risk of the average Canadian hedge fund is much closer to the risk in the Canadian bond portfolio than the long-only equity portfolio. Returns have also historically been higher. There's no guarantees that will continue. You need to diversify. And given the long time series of returns we have in order to assess the risk in the various asset classes, the point that everyone has made so far about diversification still clearly applies. It's important to have some exposure to all asset classes, and Canadian hedge funds are one of those.
There are, I guess, a couple of ways we think about this issue. One is at a portfolio level, and number two would be at a manager level. At a portfolio level, what is essential for us is to understand what all the risks actually are that we own in our portfolio, and to understand where you've got residual market beta risk, and to the extent you think you want to hedge that risk, typically from a crisis perspective, try to do that. I think we think we were living in a world where we've seen a pretty decisive structural break starting in '08, where we are living in a higher volatility world where return distributions are, I think, increasingly irregular. And I think there is a need for some level of protection in that environment where the tails of the distribution are simply fatter. At a manager level, I think, as I mentioned before, we do tend to try to focus on managers who are really taking risk where they should and hedging all the undesirable risks away. Not all managers do that. I think it's a fair comment that there are lots of hedge funds out there that frankly don't engage in much hedging and take a lot of residual market risk.